Welcome to the Simply Financial Podcast. I'm your host, Christopher Calandra. I came across an article recently. It was actually through Bank of America, where, full disclosure, I do most of my personal and business banking. On one hand, I don't like that I'm doing business with a mega bank because it can be pretty impersonal, but their technology and the fact that they have branches all over the place is kind of an advantage for me. But that's a side note. What I wanted to talk today is this article they had, 7 steps to staying financially fit. But let's get into it. The first step to staying financially fit is number 1, understand your assets and liabilities. I've talked about this before. I agree wholeheartedly with this. You want to understand your assets and your liabilities. We advocate that our clients have a personal net worth statement, also known as a personal balance sheet, where you list out your assets and your liabilities and that you track this on a regular basis to see if you are increasing your assets and decreasing your liabilities, which is the same thing as debts. And the way that you track your total wealth is to take your liabilities and subtract them from your total assets, and that gives you your net worth. So number 1 is understand your assets and liabilities. I think that's a very, very good place for somebody to start if they feel like their financial situation is a little out of control and they're feeling a little overwhelmed. Sit down and figure out what assets you have, what debt you have. Good place to start. And as I said a moment ago, you should track this routinely. Number 2, assess your goals. The article talks about once a year thinking about your short, medium, and long-term goals. I agree with that. It coincides with my philosophy. Want to make sure that your goals have not been achieved, in which case they should come off the assessment, or you may have had a change in goals. You may have accelerated some, pushed other ones out, or completely changed them. But I like that idea, once a year, having a plan that includes looking at your short, medium, and long terms makes a ton of sense. Number 3, the article talks about checking your credit report. I do not do this personally, although I have an awareness of what my credit report is, but I very infrequently check my credit report. What they would advocate is that you can get a free credit report once a year. This is something that's allowable under the Consumer Financial Protection Bureau, also known as the CFPB. It's kind of a mouthful. You may know that there are 3 major credit reporting agencies. They are Experian, Equifax, and TransUnion. You can get a free report from each of these major credit reporting agencies once a year. And so what this article advocates is checking your credit report. I think that's a pretty good idea. I am not much of a consumer of credit at this point. I think my days of borrowing money are behind me. But I don't think this is a bad idea at all. And in an age where you have a lot of identity theft and a lot of errors in credit reports, I think this makes a lot of sense. By the way, my credit is locked, so that's part of the reason why I'm not terribly concerned about checking my credit report. That means that if anybody tried to inquire on my credit, they would be unable to access my credit records, which you should and could only do sensibly as if you're not borrowing money. Number 4 is name your beneficiaries. This is a hot button topic for us here at Elliott Wealth Management. As we work with our clients holistically, we want to make sure that they have beneficiaries named on all of their accounts, and this is good advice for you as you listen to this. You should have a primary beneficiary, and you should have 1 or more contingent beneficiaries on all of your accounts, including retirement accounts and insurance policies, especially life insurance policies. Moving along, number 5 is manage your taxes. The article talks about the importance of making sure you have enough money set aside to pay your tax bill well before the annual deadline of April 15th. It is very disheartening when you get a big tax bill that's unexpected, and it is especially disheartening when you don't have funds available to pay a big tax bill. So having money set aside to pay your expected tax bill makes a lot of sense. That means you have to work closely with your accountant and CPA, maybe even doing tax projections. The amount of federal income tax that you owe each year depends a lot on your tax bracket, but there are other factors that impact it as well. So you should probably have a good appreciation of tax brackets. We discuss this with our clients regularly. You could contact Elliott Wealth Management if you want to see our collateral material about the income tax brackets. Now listen, in lots of cases, if you're listening to this, your employer withholds taxes from your paycheck. But keep in mind, the amount withheld will often differ from what you ultimately owe. So that could result in you getting a huge refund or a large refund, and or having a large tax bill, which is, as I said, very disheartening. If you're self-employed, and I know a lot of you listening are, you have a little bit of a different operation. You will pay estimated quarterly taxes, and you probably have a pretty good handle based on those quarterly taxes if you have made more money, and depending on the operation of your business, the performance of that year's profit and loss, you probably could have a pretty good sense of whether you are overpaying or underpaying your estimated taxes. Again, I would lean heavily on your CPA to help you with the management of your taxes, although as a certified financial planner, I work with my clients along with their accountants to try and mitigate taxes wherever we can. Last tip, each fall you still have time to make adjustments before year end, so consider checking the amount you've set aside for taxes against last year's tax returns. I think this tip is especially appropriate if you get a large refund or a large tax bill. Number 6 on the list is to check your investments and make sure that your goals align with your investments. It is likely that your investments, whether in retirement plans or taxable brokerage accounts, consist of mutual funds, stocks, bonds, exchange traded funds. Consider checking the investments quarterly in January, April, July, and October to make sure that everything is in order, that the investment plan is good, but also appropriate relative to your goals. They should sync up. Again, I don't want to make this too much of a commercial for my work at Elliott Wealth Management Services, but this is a major part of what we do with clients, not only to create very good investment strategies that we monitor and change over time, but the investment portfolio, the investment management process does not happen in a vacuum. It has to be coincided with an understanding of goals and objectives and time horizons. So I think the article is spot on with the advice to check your investments and make sure they align with your goals. And then the last is to make sure you have the right insurance. Their point, which is a good one, once a year you should assess the type and amount of insurance you need. For example, if you have rent, you should make sure that you have renter's insurance to protect your belongings. Then, when you buy a home, you need homeowner's insurance. Your policy should cover what it would cost to rebuild your home, which is often more than your home's face value. I'm not sure I necessarily agree with that point. But you need insurance. For many of you, that would also include life insurance, so that if God forbid something happened to you, that loved ones, those counting on your income and financial resources, are not financially harmed if something happens to you. So once a year, it's a good idea to assess if you have the right type of insurance, the right coverage amounts, as well as if you're getting the coverage at an attractive price. Another good tip on this is with property and casualty insurance, car insurance, homeowners insurance, umbrella policies, is to shop around. It's a competitive marketplace, so it is often a way that you could save a few dollars each year by paying attention and shopping around. I am not a property and casualty agent. We do a lot of life insurance business with our clients. Big believer in the need for many people to have an appropriate amount of life insurance. But in terms of property and casualty insurance, I just mentioned homeowners, car insurance, umbrella policy, commercial policies. That's not an area I play in. I refer that out to other sources that I've worked with over the course of my career. So there are the 7 tips. I thought this was really good. The 7 steps to staying financially fit. Just to review, number 1 was understand your assets and liabilities. Number 2, assess your goals. Number 3, check your credit report. Number 4, name your beneficiaries. Number 5, manage your taxes. Number 6, check if your investments and goals align. And lastly, determine if you have the right insurance. Thanks for listening to this episode of the Simply Financial Podcast. I will be back with you on the next episode very soon. In the meantime, please subscribe to the podcast and feel free to go to our website, www.elliottwealth.com, to get more information about the work that my team and I do to help our clients win with money. Thanks again.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.